Today we're going to talk about the number one reason you should never buy an annuity in your investment portfolio using after-tax funds. Most investors are unaware that annuities have significant tax consequences, and the financial planners, so-called, who sell these products generally don't properly explain the tax consequences to their clients when they're selling them the annuity contract. So today I'm going to show you some examples of how buying an annuity using after-tax funds can cause you significant extra taxes throughout the course of your life or for your beneficiaries, because the taxes that are owed never go away. Either you pay or your beneficiaries pay. And there are ways around these taxes and opportunities to pay lower taxes on your investments. So stick with me, and I'm going to show you why annuities are a tax disaster. Our first example shows just how bad annuities are for your beneficiaries. In this example, we are making a $500,000 investment in an annuity using after-tax funds and comparing that to a $500,000 investment in stocks, real estate, bonds, etc., also using after-tax funds. Let's assume that throughout the course of your life, the annuity gains $1 million versus the stock market gains of $1 million. And when you pass away, there's $1.5 million in the annuity or $1.5 million in real estate, bonds, stocks, etc. What happens then? Well, if you have an annuity, the $1 million of unrealized gain is going to be taxable to your beneficiaries at ordinary income tax rates. Their tax liability could be as much as $370,000, depending on what their tax bracket is. They're going to pay a lot of taxes. It's just a question of how much and what their bracket is. Compare that to standard investments, ETFs, individual stocks, real estate, etc., that you own in a brokerage account and are worth $1.5 million at your death with $1 million of unrealized capital gain. Your beneficiaries are going to receive them tax-free. That's right. Stepped up basis is what happens when you pass away. Your beneficiaries will receive your assets at the market value at your date of death, and ultimately they can pay no tax when they receive those assets. Huge difference. In my experience, most so-called financial planners or financial advisors or whatever they want to call themselves do not explain this massive tax consequence to their clients when they sell them annuities. And look, somebody's going to pay the tax. It's either going to be you or your beneficiaries. And you want to get away from this. I'll show you how to do that in just a minute. Now, if you already own annuities or some so-called financial planner is pressuring you to buy an annuity, please reach out to my office. We'd be happy to give you a second opinion and a different perspective on a product that probably should not be in your investment portfolio. Now let's take a look at how annuities will cost you big in taxes throughout the course of your life. Here's an example for a retired couple who has $200,000 of retirement income. And what we're doing here is we're demonstrating the difference in taxes that you would pay by having income from an annuity versus qualified dividends from stocks or ETFs and long-term capital gains. So in this example, we have $60,000 of Social Security under either scenario. The couple is receiving, in one scenario under annuity income, $140,000 from an annuity, and it's all taxed at ordinary income tax rates, versus they've sold some stocks or they're receiving qualified dividends, long-term capital gains of $140,000. The bottom line is that by receiving income from an annuity, you end up paying $13,449 more in federal tax just because of the characterization of the income. Annuities are taxed at ordinary income tax rates. Any gain in an annuity comes out as ordinary income versus stocks and other investments where you can receive long-term capital gains, preferable tax treatment, and potentially qualified dividends, both of which are going to be lower, 0%, 15%, or 20% when compared to an annuity. This table shows the detail for the annuity income example. $140,000 of annuity income for our retired couple, $60,000 of Social Security. Their income subject to tax will be $191,000. Standard deduction $32,300. That means they have taxable income of $158,700, all of which is going to be taxed at ordinary income tax rates. Now let's compare this example to a couple who's receiving $140,000 of qualified dividends or long-term capital gains. Instead of investing in an annuity, why not just buy ETFs, the S&P 500, or real estate, or bonds and things like that that can qualify for long-term capital gains and qualified dividends, lower taxes. In this example, we're receiving $140,000 from qualified dividends and long-term capital gains. This retired couple is receiving $60,000 of Social Security, same income subject to tax, $191,000, same standard deduction, $32,300, total taxable income, $158,700. It's all the same. But look what happens with qualified dividends or long-term capital gains, both of which are taxed at the same rate. $75,350 is going to be taxed at 0%, and then $64,650 at 15%, which means ultimately they'll only have $18,700 at ordinary rates, and their total tax bill is going to be much, much lower. In this case, over $13,000 lower. That's how we get to this much lower tax for this couple, because they're qualifying for lower tax rates just by changing the character of their investments. Let's say you buy a variable annuity and you have a menu of mutual funds inside that annuity to choose from, which are mostly going to be S&P 500 type investments. Why not skip the annuity and just go buy the S&P 500 index, the SPY ETF for example, and hold it in a brokerage account? Over time, throughout your life and when your beneficiaries receive it, you are likely to pay many thousands of dollars less in taxes by simply avoiding the annuity and just buying quality investments in an after-tax brokerage account. It's a no-brainer. The 2025 tax brackets further demonstrate why annuities are a terrible investment when it comes to taxation. All we have to do is look at the tax brackets. If you're in the 22 or 24% tax bracket, compare that to paying taxes at 0, 15, or even 20. You're going to pay a lot less in taxes on qualified dividends and long-term capital gains, i.e. what you would expect from standard investments, versus an annuity. Any income, any gain in an annuity is ultimately going to be taxed at ordinary income tax rates. And by the way, the more successful you become, the worse it gets. Look at the tax rate structure. As you have more income, you're going to pay higher and higher taxes on your annuity income, making the spread between qualified dividends and long-term capital gains and the ordinary income from the annuity greater and greater. So you get punished more and more with the annuity by creating more wealth and having more income. I've been in the wealth management industry for over 25 years. I've met with hundreds of wealthy families, and I've seen dozens and dozens and dozens of situations where a family was tricked into buying an annuity because they were sold a rider, lifetime income. That's usually what it is, or some other nonsense about healthcare. There's a whole bunch of riders, and in my opinion, they're just tricks. They're tricks to get you to buy a product so the salesperson, so-called financial advisor, can get a huge commission. There's a conflict of interest there. They're selling you something that's in their best interest and not yours. So I hope this video enlightens you about the tax consequences and gives you some ammunition to push back against some financial planner trying to clothesline you into one of these products. This tax stuff is irrefutable, right? You can't deny the fact that annuities do not receive stepped up basis upon your death. Your beneficiaries will inherit a massive tax liability if you have deferred gains in the contract. In other words, if the contract has had some earnings, it's made some money. Or you will pay ordinary income tax rates. Either way, it's a bad deal, and I think you should avoid it at all costs. Most of the time, an annuity is not a good product for a retiree's investment strategy, my opinion. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.